Welcome to The Debate. The market, as we all know, can be a captivating and, well, often bewildering puzzle for investors. Today we're diving into one of its most crucial enigmas. How should we truly weigh the undeniable immediate bullish price action we're seeing against, the whispers of history, those persistent seasonal trends, and the flashing warnings of technical divergences? It's a fascinating tension, really, emerging from our deep dive into SPY QQQ and TSLA, market predictions. I'm genuinely eager to champion the power of current price action and the observable bullish trend that's right in front of us.
And I'll be making the case for giving, frankly, significant weight to the predictive insights of historical seasonality, those technical divergences we see popping up, and, importantly, the underlying fundamental indicators as well potential harbingers of corrections.
Okay, so let's get into it. From my perspective, the current bullish momentum we're seeing on SPY and QQQ, characterized by these, really remarkable V-shaped recoveries and a relentless push towards all-time highs. Well, that's the most reliable guide an investor has right now. This strength isn't accidental or, simply organic. It's actively sustained by market makers, the large institutions facilitating trading, and their strategic use of options chain activity to, as we sometimes call it, squeeze the shorts. Now, this isn't necessarily outright fraud, but it's more like a calculated strategy where short sellers are forced to cover, creating this sort of self-fulfilling upward pressure that can seemingly defy traditional bearish setups, like that head and shoulders pattern we actually observed on QQQ just recently. The market's consistent ability to just completely buy back up after dips, despite what might appear to be warning signs, clearly demonstrates that immediate price action and the observable trend are paramount. We are simply, I think, not ready to start filling a lot of those gaps below us yet, and the most logical approach seems to be to play the price action in front of you.
Right. And while I acknowledge the market's current rallies, I firmly believe it would be a mistake, frankly, to simply ignore the robust warnings coming from historical seasonality, significant technical divergences, and underlying fundamental weaknesses. Seasonality data, especially from tools like Forecaster, it clearly indicates a predictable pattern for SPY and QQQ. Some downside for the first week of September, okay, followed by a bounce by the second week, and then a potential sell-off in the third to fourth week of September. And for Tesla, well, historically, October is the most bearish month of the year.
Furthermore, we're seeing these quadruple bearish divergences on SPY and QQQ, particularly on the 4-hour Relative Strength Index, or RSI. Now, for those less familiar, a divergence basically signals that while the price might be rising, the underlying momentum is actually weakening, which is often a red flag, for a potential reversal. Seeing this 4 times over on a 4-hour chart suggests a significant, possibly deep-seated fragility. And when you couple that with plenty of gaps to fill below for both indices and Tesla's fundamentals looking, well, overvalued based on analyst fair value estimates, plus declining growth, margins, and sales, these signals provide crucial foresight into impending corrections. It just feels imprudent to disregard them completely. Okay, thank you for that crucial counterpoint. It really does highlight the tension perfectly. Now, how do you directly respond to those warnings from historical seasonality and the bearish divergences you just outlined? You acknowledge manipulation, sure, but you still lean heavily on historical patterns. So my question to you is, how can we truly trust those patterns when, as I've argued, market makers seem to be actively squeezing the market in ways that fundamentally alter traditional reactions? Doesn't that, at least in the short term, maybe render history less reliable? This current market environment feels profoundly shaped by this calculated influence, which can make historical correlations like that intriguing 93% correlation we observed between the current setup and a similar event 5 years ago, perhaps less relevant than the immediate, almost parabolic price action we are witnessing right now.
The market's resilience, its ability to push prices higher despite recognized bearish setups like QQQ's head and shoulders, that's a testament to this power. To me, this dictates that following the present trend is really the most effective strategy for now.
Well, advocate, I can certainly see the force in your argument about market maker influence, and it's absolutely a critical factor in understanding short-term volatility. However, I'd contend
that even significant manipulation can't indefinitely defy established historical patterns. Aren't we maybe giving a bit too much credit to these short-term forces when long-term history shows such consistency?
Fair enough, but
While manipulation is indeed a factor, it likely can't perpetually override what typically happens. Seasonality offers valuable, let's call it, hindsight about what typically happens. And the current rally, particularly for SPY and QQQ, it still broadly aligns with that first week downside, second week bounce pattern before a forecasted mid-September sell-off. Ignoring these consistent historical signals alongside those persistent quadruple bearish divergences on the 4-hour chart, it just leads investors to become, I think, too complacent, leaving them vulnerable to an eventual rug pull when market sentiment becomes overwhelmingly greedy, which we're starting to see hints of.
A rug pull is certainly a fear that haunts many investors. I get that. But by constantly anticipating the worst, aren't we risking the opportunity cost of missing out on genuine momentum in what looks like a pretty robust rally? Where do we draw that line? Let's turn to the significance of those unfilled price gaps and the underlying fundamentals. My position is that the market's current trajectory seems prioritized on breaking out to new all-time highs, and it is simply, perhaps, not ready yet to fill the numerous historical price gaps that exist below. For Tesla, for instance, despite analyst estimates suggesting it might be a little bit overvalued around $274 a share, and yes, the recent declines in growth margins and some sales figures, its current price action suggests it could continue to rally, maybe towards the 340s, perhaps for another month before any significant correction. This, to me, indicates that in a strong momentum-driven market, fundamental weaknesses can become secondary to current price momentum, at least in the short term. And, while market maker influence is a factor, this current bullish run also reflects some broader resilience. We're seeing solid corporate earnings in key sectors, for instance, which provides an underlying economic stability that I'd argue validates the immediate price action even when tactical manipulation is at play.
I'm not entirely convinced by that line of reasoning, Advocate, especially when we talk about what the market is ready to do. The existence of plenty of gaps to fill below, on QQQ for instance, down at 565, and SPY with multiple gaps in the 640s, 620s, 607, even 600, these represent, almost inevitable downside targets eventually. As we know, most gaps do get filled eventually. To say the market isn't ready yet doesn't really negate their predictive power. It maybe just postpones the inevitable reckoning.
Okay, I see the point on inevitability.
Most bearish month of October, a period of potentially high vulnerability. I believe these fundamental factors, combined with seasonality, provide a critical long-term outlook that ultimately should override short-term rallies driven purely by momentum or these tactical maneuvers.
That's a strong point about the inevitability of gaps filling dissenter, but the timing is everything, isn't it? Which brings us to navigating timing and risk, immediate signals versus those forward-looking warnings. My view remains that investors should probably continue to play the trend in front of you and remain, let's say, bullish for now, because fundamentally, it feels like the bulls have a bigger edge in the specific market environment right now. Even the forecaster tool itself, while it highlights seasonality, also suggests we're still going higher in the very near term, and that we're not getting any major sell signals yet on some advanced DPO indicators for QQQ and SPY. This implies current rallies could persist for, say, another week or two for the indices, and maybe another month for Tesla. So strategically, it seems sound to ride this current momentum and only consider getting more cautious once we get to mid-September for indices, or perhaps October for Tesla. By constantly anticipating the exact top, aren't we often leaving significant gains on the table?
Advocate, I understand the desire to ride the momentum, of course, but I would argue that prudence really dictates preparing for those risky periods that are pretty clearly signaled by both seasonality and the technical analysis. We have mid-September for SPY and QQQ, potentially coinciding with the FOMC meeting on September 17th, which is always a catalyst, and October for Tesla. The market mood indicators are showing increasing greed, which, has historically been a strong contrarian indicator suggesting a top might be forming or is near. Even with ongoing rallies, the presence of those persistent bearish divergences means the higher we go, the more very, very careful investors probably should be. Proactive risk management, maybe preparing for significant downside again in the next 2 to 3 weeks for indices and in October for Tesla, seems essential to avoid being caught in a sudden, sharp reversal. My main concern is that by focusing solely on playing the trend, we risk neglecting the very real warnings that could empower us to protect capital when the tide does turn.
Well, today's discussion has certainly illuminated the critical tension investors face, whether to prioritize the immediate, often influenced bullish price action, or to heed those forward-looking warnings from historical seasonality and technical divergences. I presented, I think, a compelling case for following the observable current trend, highlighting how market forces can extend rallies, and yes, the potential for missing gains by reacting perhaps prematurely to anticipated corrections.
And I, conversely, have provided what I believe is a strong argument for respecting the powerful predictive insights of historical patterns, those persistent bearish divergences, and the underlying fundamental weaknesses, particularly as we approach specific high-risk periods identified in our source material. This exchange really underscores the inherent complexities of market forecasting, where different analytical lenses can offer conflicting yet still valid interpretations.
Absolutely. Ultimately, navigating this landscape requires a deep understanding of both the immediate price action in front of you and those broader historical tendencies, alongside the technical warning signs. There is always more to explore in how these powerful forces interact and shape the market's trajectory, and how we can best adapt our strategies moving forward.